Indian stocks have had a wild ride in 2021. They have more than doubled from March 2020 lows, but the rally appears to be abating with sharp losses in November. Sentiment towards new listings has also soured after a disappointing debut by Paytm, sparking a debate over the valuation and profitability in the fintech space. Gautam Duggad is the head of research at Motilal Oswal Financial Services, joining us live from Mumbai with his thoughts on the markets. Gautam, it's great to see you. Hope you and your team are keeping safe. Thanks very much for joining us. Give us your own read on where the markets go from here and what would you advise on investments?
Hi, Tanvir. So we've seen some correction finally after a long time. As you mentioned, we've had a linear rise from the lows of March 20 to almost October 19 peak of somewhere about 18,400. So market was anyways looking for a cue for correction, and that was provided by this new variant around which there is a lot of uncertainty even now. What has however happened is while the index is corrected 8% or thereabouts, there are a lot of stocks and sectors which have seen a significant downtick. So around 44 stocks in NSE 500, which is the widest index in India, has seen correction of more than 20% almost. So valuations relatively now compared to 2 months back have become relatively more reasonable, even at index levels, and some of the stocks which have seen a big downtick of 20-30%. The way I look at this market is while there will be an uncertainty around this new COVID variant, how the Fed tapers, what directions the interest rate takes globally and in India. If we are around this level, say 3 months hence, and when the market starts anchoring FY23, FY24, we will start trading at about 18.5, 19 times on index. Just remember that in the last 6 months, there has been no damage to the earnings estimates yet. We are still at an EPS of 730 rupees for FY22 and about 873 rupees for FY23. This was the estimate even 6 months back. So despite the input cost inflation, so much of headwinds that we have seen in some of the sectors in the second quarter results, at the aggregate level, the index has not seen any damage to the earnings. So I'm quite sanguine about the markets because the earnings cycle seems to have turned after a decade. And we have seen the evidence first in FY21, and that is continuing in FY22. So while rates will go up, that's the nature of every bull market that we have seen in the past. Rates do go up because the growth picks up, inflation also picks up, and the central banks obviously do what they've done in the past. They will raise rates at some point of time. But if earnings continue to accelerate, I don't think there is a reason to be too worried about the market from a slightly longer-term point of view.
Okay, and what about valuation risk, especially with the new age stories, stocks, digital economy related?
That is a very different world, Tanvir, altogether. We have seen how some of the issues have not seen the successes that one had anticipated. Yesterday, we saw even Star Health did not see a big bang subscription. So clearly, people are getting more cognizant about valuations after the listing of Paytm. So, I mean, this is a trade for brave heart investors because you have no clue when the profits will come, whether they will come in FY24, FY25. Even the management themselves are not pointing to any near-term profitable year as far as guidance is concerned. So if somebody has a very long-term view, because some of this business will definitely become very big. And in digital internet space, we have seen that winner takes it all. But you have to bet on the right, kind of a horse and jockey. So far, we've seen that companies like Nykaa, companies like Zomato, which have a big leadership position in their respective domain, and they are growing, and Nykaa is growing profitably as well. So some of those issues, some of those companies will definitely tend to do very well over a period of time. But companies where there is no path to profitability and the valuations are abnormally expensive, I think people will struggle to make returns in the next 1 or 2 years. So, I belong to a school of thought where profits and cash flows are very important. So we have so far steered clear of these companies in our model portfolio. We don't have any digital companies so far in the model portfolio or any loss-making companies, so to say.
And what happens with Indian IT? Because world over, the place to hide, it seems like in an uncertain environment, so to speak, has been tech. And I know that Indian IT is a different kind of tech because it's software. And a lot of it is the back-end services. But even so, what is your own view on how tech is shaping up in India?
So we are extremely positive on tech. This is the highest overweight in our model portfolio at about 300 basis points. And this has been the case for last 2 years now. And this has worked well for us so far. If you go by the commentaries of the companies, especially tier 1 IT from the quarter that has gone by, it seems that demand is accelerating very rapidly. They are actually struggling with supply, and that is why we are seeing a huge attrition in the IT companies. More importantly, what gives us comfort is the tremendous cash flows that they generate. 90% free cash flows are anyways returned to shareholders. So capital payout is very high here. So despite a relatively modest earnings growth there in the last 4 or 5 years, we have seen almost 30% compounded capital payout in these top 5 IT tier 1 companies. And because of that, we have seen a very good re-rating also in IT companies. I think the demand for the next 2-3 years because of this digital transformation and this entire movement towards cloud and IoT will keep the order books bulging for the IT companies. There can be some impact on margins in the near term because of as and when travel returns, as and when wage inflation picks up. But I think that is par for the course. As long as cash flows remain so strong and demand remains very, very strong, I don't think you're going to see a massive correction in IT stocks. So at every correction, we will look to add the IT names. And as I said, this is the highest overweight in our model portfolio for now.
Give us your top 3 stock names in India that look attractive at these levels.
Yeah, I mean, from the last time when we spoke, those names haven't changed much. We continue to like Titan. That has been our #1 consumer discretionary pick in India for a very, very long time. And we still believe that opportunity remains massive for them because the unorganized and even the organized on the regional side, which is the branded organized players, so to say, but smaller in size, continue to struggle. And Titan is gaining market share left, right, center. So that remains one of our top ideas. The other name we like after this correction is ICICI Bank. Valuations are looking very juicy now for the mainstream large cap financial names, right? Despite very strong results over the last 4 or 5 quarters, the stock, or rather the bank Nifty itself hasn't done much. They've underperformed for a very long time. So I think as and when things rebound, the large cap financial stock should do very well. And a third name that we like, which is a broader play on capex recovery going forward, is Ultratech.
Gautam, lovely to have you on the show. Thank you very much. Completely out of time. Thank you very much for joining us with your insights on India. That does it on this edition of Street Science. Thanks very much for watching the show. Have a lovely Friday. Have a lovely weekend. We'll see you Monday morning, same time, same place. For now, stay tuned to CNBC for more news and updates.